All right, I hope you enjoyed that video. Learning to speak the language of finance is like speaking a whole nother language when you're learning it. Now, let's start off with an example. Suppose you had a friend, and this friend came to you with a business idea. And they said, James, I would really like you to invest in my company. What are the questions that you would want to ask your friend before you put $10,000 or $100,000 into your friend's business? You would probably ask first, what products do you sell? Do you sell these products for more than they cost? Then you would ask, how fast are you growing? Tell me about how fast the growth is. You would ask about what assets do you have? Do you own stores? Do you own trucks? Do you own manufacturing facilities? And these are the questions that you would want to know before you would invest in the company. And then you would want to know how much it costs on an ongoing basis to run this business. Are they profitable at this point, or do they drain cash every month? And all of these questions can be found in the financial statements. There are three primary financial statements that we go through as investors. And these are the balance sheet, the income statement, and the statement of cash flows. So first, let's talk about the balance sheet. And first, to kick it off, we'll watch a video made by our friends at Wall Street Survivor to explain the balance sheet.
What is a balance sheet? Presented by WallStreetSurvivor.com. A balance sheet is a snapshot of all the assets and claims to assets a company has at a given point of time. A balance sheet has three sections: assets, liabilities, and equity, which must always be in balance. Here's why. Every company has a number of resources, some owned and some borrowed. Resources that are owned are considered assets. Resources borrowed are considered liabilities. Here's Wayne. Wayne owns a chain of profitable cowboy gear stores in Texas. The Cowboy Hut is not a publicly traded company, so financial statements are not required. But Wayne has some private investors who feel preparing a balance sheet will be helpful to get an idea of the net worth of the company. Wayne begins counting all his assets, starting with the most liquid. Liquidity means how quickly he could sell his assets if he needs to. Wayne counts $50,000 in cash. He also notes he has $20,000 in payments due from customers paying on credit. He files that under accounts receivables. Finally, Wayne adds $50,000 in inventory and sums all of those up as current assets. Next, Wayne counts that the Cowboy Hut has $600,000 in property from their retail stores. This is a long-term asset. On the flip side, Wayne also begins to count up all the liabilities or claims to the company's assets. Like the assets section, he lists them in order of liquidity. First, he records all the bills he has to pay to his suppliers. These are the company's accounts payable. He also records the rest of his other current liabilities, like his line of credit. To pay for the company's retail store, Wayne took out a $300,000 loan from the bank. This loan is filed under long-term liabilities, since Wayne will pay back the entirety of the loan over a long period of time. In the final section, Wayne records the Cowboy Hut shareholder equity. First, Wayne records the par value of the shares issued to the investors of the company. This is done by multiplying the number of shares issued by the share price. Lastly, Wayne adds the company's retained earnings. Retained earnings is the cash left over after operations, or profit. Retained earnings is the link between the balance sheet and the income statement, which records revenue and expenses. To learn more, head over to WallStreetSurvivor.com.
All right, so the balance sheet is like a photograph. It's a snapshot of a business where they are at that period of time. So at that year end, December 31st, it's a snapshot of all of the assets and all of the debt and all of the equity that that company has. So what does that mean? Let's go through, let's take an example, and you'll find the example of Apple. So this is Apple, their financial statements in the year 2014. And let's go through these main line items. So we see balance sheet. The first one is the cash. So this is the amount of actual cash and cash equivalents that Apple has in the bank. And this would be here $13.8 billion in cash. So that's a tremendous amount of cash that they just have sitting in their banks, right? The next item is accounts receivable. What does accounts receivable means? This is the amount that is due to Apple. So they have sold perhaps iPhones to telecom providers, and they've made the sale, they've delivered the good, but they're still owed that money. So that is nearly like cash in the bank because it's owed to them. So here we see that there's $17.8 billion in accounts receivable to Apple. The next item is inventories. Inventories here for Apple is $2.1 billion that they have in inventories. What does this mean? This could mean components, so they may be buying semiconductors and putting these chips or components in an iPhone and with the glass of the screen or their products, and this would be classified as inventory, the boxes of semiconductor chips sitting in their warehouse. They also may be finished inventories, so they may be the inventories of finished MacBooks or iPhones that are sitting in their warehouses. And total, this accumulates up to $2.1 billion. The next item is property, plant, and equipment. This is the total manufacturing assets of Apple. So this could be their manufacturing facilities, this could be their warehouse, this could be their trucks, the items that they own. So here is $20.6 billion. And in Apple's case, a lot of this is their equipment and their machines that they've bought over the years. So next, let's turn to liabilities. Now, liabilities are the accounts. First, let's look at accounts payable. So here it's $30.2 billion. This is the amount, it's opposite of accounts receivable. This is the amount that Apple owes to pay its suppliers. So Apple is buying semiconductor chips and they're buying components, and they are delivered the items, and then they are going to pay that bill in, let's say, 30 days or 60 days. So they have $30.2 billion in accounts payable. The next item is long-term debt. Apple has $29 billion in long-term debt. This is debt that either they've issued corporate bonds or that they've gone to banks, and banks have given them a loan on that they will pay interest on. So remember, Apple had $13.8 billion in cash, but they also have $29 billion in long-term debt. So debt is an important item to know. The next big category is equity. So in equity, we have common stock. And common stock is how much stock Apple issued when they went to their IPO and went public. So when they issued shares, their common stock is now worth $23.3 billion. And then after they've issued shares, they have accumulated profits and retained earnings. So retained earnings is a much higher number at $87.2 billion. So every year when Apple generates profits, it pays a dividend, so it pays its shareholders, but it also takes some of those profits and puts them back into the company. And here you would put this in retained earnings. So there's a formula for the balance sheet, and we have to remember that assets equals liabilities plus equity. So these two items will always balance. If you are increasing assets, you maybe have to increase your debt. If you're building a big plant, you may have to increase your debt, or you may have to issue equity to fund that amount. So I hope that's helpful to understanding the basics of what a balance sheet is.